All right, it is 3:01. My name is Gonzalo Garcia. I'm the managing partner at Agency One, and I'm thrilled to have the opportunity today to talk about converting home equity into financial success. We have a couple of speakers with us today from Cornerstone Financial, and they will be handling the bulk of the presentation. My role here is as a moderator. We will have everybody off microphone. If you have questions, please use the Q&A function in Zoom or use the chat. I will be monitoring it. My colleague Kathy Neifeld will also be monitoring it, and we will make sure that your questions are addressed. As with any insurance, financial, or other planning strategy, Agency One's role here is to make sure that advisors across the country know that these things are out there. Our role here is to expose you guys to these two fine gentlemen who I've known for a long time. I'll introduce them here in a minute. You have to decide whether this transaction is appropriate for you, for your practice, for your clients. Agency One does not provide legal or tax advice, so I would just make sure that that disclaimer is out there. Without further ado, I'd like to introduce Craig Horn and Dan Anderson. Craig is a seasoned leader in the reverse mortgage industry. He co-founded Cornerstone Financing and serves as CEO and has served as CEO of Reverse Mortgage Investment Trust. Notably, Craig held key roles at MetLife Bank and co-founded Everbank Reverse Mortgage. His career includes senior positions at Lehman Brothers and SPG Warburg, where he pioneered proprietary reverse mortgage products, and securitizations. Craig's expertise drives ongoing innovation and growth, making a significant impact in our industry. I've known Craig for 30 years. He is a very bright guy, and I'm looking forward to hearing Craig talk about this. Dan Anderson is also a at least 25-year relationship. He and I served on the executive team at Bisis, now Crump. He ran Madison Brokerage and sold to Acrisure in 2019. He is now partnered with Craig to lead Cornerstone Financing. Without further ado, Craig and Dan, the show is yours, and thank you for being here.
Great. Thank you so much, Gonzalo, and welcome Team Agency One and all the participants. My name is Dan Anderson. You heard my bio. As Gonzalo mentioned, I come out of the insurance distribution space. So we're going to roll through a brief deck. Myself and my partner Craig will present, and we'd just like to introduce you to a brief video that'll basically set the stage at a high level for things to follow. So let her run.
In the world of finance, there's rarely a win-win. Well, there's one now. Introducing CHEIFS from Cornerstone, a transformational holistic planning opportunity that efficiently converts dormant home equity into tax-free cash. It allows homeowners to purchase annuities, life insurance, and long-term care efficiently. CHEIFS helps you enhance the financial, retirement, and legacy planning for your clients. This is not debt or a reverse mortgage. Rather, this is an investment in your client's home. Cornerstone purchases a fractional interest in the home and remains a minority partner until either the home is sold or CHEIFS is paid off. Homeowners retain majority interest and continue to enjoy all the benefits of home ownership and the satisfaction of having converted home equity into a holistic financial plan. CHEIFS makes home equity work for everyone. It's a win-win. In the world of...
Well, there we go. So hopefully those 57 seconds were informative enough to allow you to continue to listen to the presentation. So that's our video. This slide obviously speaks to the asset class that we're freeing up. As you know, there's obviously been traditional financial planning methods have been around for 100+ years. Now there's a new way to think about funding retirement and insurance opportunities. And as you know, historically, the only opportunity to fund or utilize, proceeds to fund insurance and investment-related products is to utilize or spend cash on hand and or liquidate investments which have ramifications. And those ramifications typically include tax consequences. So we're created a new opportunity. That opportunity is to utilize dormant home equity. We convert it to cash in a highly efficient manner in a tax-free basis. to open up a new asset class to obviously improve customers' lifestyles. So I'll turn it over to Craig to run through the next series of pages on the deck.
Dan, thanks. And Gonzalo and team, thank you very much for giving us the opportunity to present today. The next couple of slides, we'll get into some more detail around the CHEIFS product itself. But we want to sort of provide you with what we think is a total addressable market here. To kind of put it in perspective, when you see a slide that says there's more than $31 trillion in home equity in the United States, the annual new premium market for life insurance, annuity, and long-term care is $400 billion. So put that in perspective. $400 billion of cash on hand and or investment portfolios are being liquidated in order to fund all of that life insurance, long-term care, and annuities that you all advise your clients to consider taking out. And what we're sharing with you is that there's $31 trillion of a dormant asset class that might be a better way for your clients and for you to think about how you can grow your practices and serve your clients better. The takeaway from this slide is kind of interesting, and it's about which asset you invest in really does matter. Home ownership, as you all know, has historically been a very binary proposition. You either own 100% of it, whether you have a mortgage or not, or you own none of it and you're a renter by definition. What we've been able to create is a third rail, a third way, where you can actually sell 20% of your home and you retain 80% of the economic benefits associated with your home. Of course, you retain 100% of the utility benefits associated with your home. In other words, you can live there as long as you want. You can improve it as much as you want. You can do whatever you want with respect to your home. It's your home. It's just that we've invested in your home and we now own 20%. You continue to own 80%. And what's important is that how you allocate your assets is really important. Historically, home prices have gone up less than 5% per year from World War II. And as you can see, the stock market has done more than double that over that same period of time. So if there was another way of investing, and there is, I think this slide shows very, very neatly that there are better ways to invest than putting all your eggs in the housing basket. So this is how CHEIFS works. The example we have here is $1 million house, and we make an investment of $200,000, which represents a 20% investment in your home. On day one, our interest in your home is 20%. That interest will grow over time to allow Cornerstone to generate a reasonable return on our $200,000 investment, with two very important caveats. The first one is we will never earn more than a 12.99% return on our $200,000 investment. It doesn't matter if home prices go up 10% or more per year. We are capped at a 12.99% return. Secondly, we cap our interest in the home at 50% or less. In this example, it's 45% is the cap and the interest that we could ultimately own in this house. And we do that to ensure that we are always a minority partner in your client's house. If you look at the right-hand side of the slide here, you can see what our returns are at a $200,000 investment in $1 million property. Like other insurance products, the cost tends to be a little bit higher up front, similar to a surrender charge you're familiar with in the insurance policy space. But if your client stays in a CHEIF for a longer period of time, we define longer period of time as 10 years or more, there are very few home equity financing products out there that fund as efficiently as CHEIFS do. And you can see that on this next slide. Other alternatives, such as reverse mortgages, home equity lines of credit, if you look out 10 years or more, they are much more expensive ways to extract equity in your home than a chief. And of course, a reverse mortgage is much more expensive in the first 3, 4, 5 years versus a chief and versus a HELOC. The point being is that if your client is looking to take on a transaction that is 10 years or longer, there's nothing more efficient out there than a chief versus other forms of financing.
And what Craig didn't mention is obviously there's no payments associated with Chief. In this example, there's debt service here, which has ramifications.
So what we're going to go into is a couple of case studies to really help sort of pop out how a chief works. Yes.
Craig, excuse me, there's a question from Ms. Solomon. How does Chiefs make money exactly if there is no debt to the homeowner?
So the way a chief works, pretty straightforward.
Good question, by the way.
We make an investment, and when that house is sold 5, 10, 15, 20 years later, doesn't matter. There's no term on a chief. Your client, the homeowner, is in full control of when they pay off the chief. At that point in time, we own a pre-specified percentage of the value of the property. So if that property sells for $2, $3 million and we're entitled to 25% of it, we get that amount at the time of sale. From your client's perspective, that $200,000 that we wrote to your client on day one, they can do with those proceeds whatever they want. They can buy a long-term care policy. They can invest it. They can purchase a life insurance policy. That's up to them. And that's based on the recommendation of their advisor as to the best way to use that money. No different than your recommendation to have that client liquidate $200,000 of their investment portfolio to buy something. We're allowing you and your client to not deplete cash on hand, to not liquidate a portion of their investment portfolio. We eliminate that funding conflict that often happens between an insurance advisor and a financial advisor who manages their investment portfolio. And we allow both advisors to look at a third asset class, a dormant asset class, and oftentimes your client's largest asset class.
So Craig, let me just unpack this because there's a follow-up question from the same person. So in that example, if you can go back a slide, in that example, you had $1 million property, assuming no mortgage, right there. Thank you. So if you look at this graph, there is an assumed 3% growth on this graph of the $1 million property. So at some point in time, there's a cap. Now, he used 25% as the example in his comments, but in this case, it's 45%. So after 10 years, there's a capped ownership interest by Chiefs, and it will remain capped for the rest of the period. So let's say that in year 20, the house is sold for $1,806,000, then Chiefs is entitled to 45% of that, which ends up being the equivalent of a 7.26 effective interest rate, if you will. Is that accurately represented, Craig?
Yep.
Is it recorded on the homeowner's title? And sorry, well, I'm getting some questions kind of fast and furious. Sorry to interrupt, so I'll just kind of keep this moving, but
No, Gonzalo, those are great questions. So like any kind of home equity transaction, we too take an interest in your house, and that interest is recognized through a mortgage or a deed of trust. This is not a mortgage transaction, but the mortgage itself allows the world to know that we have an interest in your home. And when that property is sold, we're entitled to whatever we're entitled to. In this case, 45% of the value of the proceeds of the home.
thank you. Sorry to interrupt. Keep rolling.
No, great questions.
Well, Gonzalo, if you think it makes sense, let's take the audience through a couple of examples, because I think this really highlights how Chiefs works for your clients.
And these examples are all obviously insurance-related policy examples. I mean, there's infinite examples to use for Chiefs funding.
So here we've got a 55-year-old female who has a couple of college-age children. Most importantly, takeaway on this slide is that her mom's been in a nursing home for a couple of years, and that's weighing on her mind. She happens to have $1 million house with an existing mortgage. It's useful to know that Chiefs can be done with a mortgage on a house. Chiefs can be done without a mortgage on a house. So we have some flexibility with respect to how we handle a Chief transaction with a mortgage, without a mortgage. In this example, our client wants to buy a John Hancock Protection IUL with an LTC rider, and she's looking to purchase up to $750,000 of a death benefit and a long-term care benefit that would pay her up to $15,000 per month. And with a Chief, she can do this without having to liquidate any of her investment portfolio. So there's no tax implications. She continues to allow her portfolio to earn the kind of returns that she's hoping for, and she doesn't have to use any cash on hand. So how does she do it? Well, with her $1 million house, Cornerstone would make an investment of $157,000 plus in her home. That $157,000 plus would be used to purchase this particular insurance policy, and Cornerstone would be entitled to, on day one, an interest in her home of 15.75%. That interest would grow and then ultimately cap out at just over 35% of the value of her property. What's interesting about this slide is that when you compare the internal rate of return, if she paid for this policy with cash, which you can see in the red columns, versus the internal rate of return by buying this policy using Chiefs, Chiefs does better than cash with this particular insurance policy 100% of the time. Why is that? When you pay for anything with cash on day one, it has the impact of anchoring down your returns. But a Chiefs transaction has two things going for it. One is you don't pay that premium on day one. You don't pay that premium until you decide to effectively pay that premium when you pay off the Chiefs transaction. That could be in 10 years, it could be in 20 years, it can be in 30 years. Secondly, and very importantly, you get to benefit from the reinvestment returns on that $157,000 that you did not have to spend on day one. We assume in this scenario that you earn 7% on that $157,000 until the policy is paid off and the Chief is paid off. When you combine the return on that investment, plus the fact that you don't have to pay the premium for many, many years, even at a 3% increase in home prices over time, Chiefs IRRs are multiple times greater than cash IRRs for this same policy. And you're going to hear this said over and over whenever you're looking at a policy that has a modicum of leverage. It's just the way finance works.
Hey, Craig,
Interestingly, yeah, Gonzalo.
Go ahead. And before you move on to the case study, I didn't know if you were done or not. Before you move on to the case study, I've got a number of other questions. Maybe we could just take a pause and hit some questions and then go on to the next case study. Go ahead.
Of course.
Yep.
So just one last thing, Gonzalo. In this particular scenario, and it holds true in the next couple of scenarios as well, should Susan Smith pass away somewhere between years 20 and 25, the death benefit associated with her policy would actually be enough to pay off the Chief liability. In other words, she could leave the home to her children, mortgage and liability free, and use the tax-free proceeds from this policy to pay off the Chief. She doesn't have to, but she has options. And the point is, this particular form of premium funding puts Susan Smith in complete control. She chooses when to sell the house. She chooses when to pay off the policy, pay off the chief. If she pays off the chief, the policy remains outstanding. It was paid for on day one by Cornerstone. So she's in complete control. And of course, the IRRs associated with this particular transaction, Chiefs versus cash, is very compelling.
And if Susan Smith sells the home in 10 years, she still owns the policy and maintains it. That's a separate transaction. We don't have any hooks or any assignments on any insurance or any financial structure, period.
Unlike traditional premium finance.
Exactly.
Gonzalo, you said you had a couple of questions come in.
Yeah, a couple of, I'm trying to break them down. Is there an age qualifier? Is there any age qualification
None at all.
on the upper side or lower side? Okay, great, thank you.
Oh,
Is there,
yeah, but we say equity qualifier, not age, equity. It's all
Sure.
equity based. Yep.
Sure. What about, is the chief recorded on the homeowner's title? If so, how?
So we secure title insurance policy in the event someone has no mortgage on the house. So we will do a title search to make sure that there are no existing liens, and there will be a lien recorded at the local registrar's office to let the world know that Cornerstone has an interest in this particular property.
Thank
Just
you.
like a mortgage transaction, by the way.
Yeah. Okay, a couple other quick questions, and then we'll hit the next, and I know there's quite a few more questions coming in. Does this have to be disclosed on an application for life or long-term care insurance or annuities? And if so, how are the carriers looking at it? Dan?
Fantastic question. Part of the journey is, yes, there's been a number of carriers and distribution partners that have been exposed to Chiefs, and they're delighted and anxiously awaiting funding. First of all, this is a non-debt instrument. So premium finance, no. Candidly, the carriers have said to us, and I can name 4 of them, said, why are you even asking us carriers, the suitability? This is no different than selling your Exxon stock to fund a life insurance contract, or it's no different than having a 60-year-old downsize from $1 million home to go to a $500,000 home to free up cash to buy long-term care, life insurance, and annuities. So to answer the question, it does not require carrier approval, period.
Thank you. And then there's 3 more questions, so I'll hit these very quickly. Does Cornerstone become a named insured on the residential homeowner's insurance? Can the home insurance company decline renewal of a home, presumably because of a second equity owner?
Yeah, so we become a named beneficiary on the homeowner's insurance, just like a mortgage, lender would as well. And while we have no control over what a homeowner insurance provider would do with a home on a go-forward basis, there's zero reason why a homeowner's insurance policy provider would have an issue with a chief lien on a house. It's no different than someone having a HELOC on a house or a cash out refi on a home, and you've got 2 mortgages. It's the exact same thing.
And your team during this process does a lot of the handling of that paperwork and transactions and liens and so on and so forth, right?
It's exactly what we do, Gonzalo.
On the fulfillment side.
Your advisor clients are responsible for policy and carrier selection. We have nothing to do with that.
Mm-hmm.
And likewise, when it comes to the chief fulfillment process of getting an appraisal, of doing the title work, that's all us. It is nothing on you. Of course, we keep you informed throughout that 3 to 4 week process, but it's on us, not on you.
Right, and it's recorded as a second. Is it a lien? Is it recorded as a lien, or is it recorded as a second?
So it is a lien can be a first or second position. A chief can be in a first or second position, depending on whether there's a mortgage or not. And it is recorded.
Okay, I'm going to do 2 more questions because they're pertinent. I think one of them I'll leave a little bit towards the latter part. Can the payoff to Chiefs be at the time of sale? Presumably, again, at the time of sale of the home, right? The answer is yes to that.
Yes.
And then finally, how is Chiefs funded? Where is their money coming from? Maybe
Well,
you
that's a
want to
great-
talk about your source of funds and yeah.
Happy to. So,
Good question.
about 3-4 weeks ago, we announced that we secured $285 million of warehouse financing from two large Wall Street institutions, Nomura and Aquiline. This is public information. I'm not sharing with you anything that's confidential. And that $285 million is a revolver. In other words, we can borrow from those facilities $285 million. That represents $285 million of potentially new premiums
Say that again.
that we can fund, 285 million of new premiums that we can fund.
As a revolver.
And when we're done, we can replenish that $285 million and do it again and do it again.
Okay, and there's no maximum time frame for the Chiefs, right? If the family lives in the home for 50 years, then they sell the home at the end of 50 years. That's
No expiration.
yeah, okay.
That's exactly right.
There's a couple more questions. Let's do another case study and then let me get to the other questions then.
So this next case study is similar to the last one, Gonzalo. The difference being it's on a much smaller house, $600,000 house, no mortgage, similar type of situation, wants a death benefit, wants a long-term care benefit. They looked at a nationwide protector product, looking for a $500,000 death benefit and a $500,000 long-term care benefit. And again, this is how it works. Cornerstone invests in this particular scenario just under $114,000 in your client's home. And that $114,000 is used to buy a $500,000 of death and long-term care benefit through that nationwide protector policy. We have on day one an 18.9% interest in the home, and that interest grows to 42.6% over time. Again, I'll reemphasize, we can never earn more than 12.99% on our money. And as you saw before, if this individual were to stay in their home for 10 plus years, the cost to them for taking out a chief goes into the high to middle single digits over time. It's really effective financing. So that's just one other example of, what I would call a hybrid type of product. Gonzalo, if there's no questions, we can go.
Let me just, I have a question because I think it's a clarifying question and there are a couple more questions here. Craig and Dan, so we've looked at a couple of examples, 17% to 34%. Now you're using 18.95% to 42.65% as a cap, right? So can you talk about how do you arrive at the numbers that you're arriving at? Where did the 17% come from? Where did the 18.95% come from? How is the cap established? Because I think that's, I would imagine there's some people on the call saying, how do they come up with these numbers, right? So walk us through that.
Yeah, so the initial interest is actually really straightforward. 18.95% actually equals the $113,735 divided by the $600,000 home price.
Mm-hmm.
That's it. So we wrote a check for 18.95% of the value of your property. And on day one, we own 18.95%. If that home was sold 1 year later, our interest, if we go back to, and Gonzalo, I'm going to go back a couple of slides here.
Yep, go ahead.
If that individual were to pay off their house after 1 year, we would be entitled to 21.94% of the value of the property. So our interest grows over time, and it's capped on the Eleanor Tripp example. I'm going to go back to it now. Mm-hmm. At, I believe, 42.65%. Why is it capped at 42.65%? We're trying to find a return profile that allows us to earn a reasonable return on the $113,735 that we invested in your house. And as you saw on page 10, in the early years, we're looking for a return that is closer to 12.99%. I'm going to go back now, Gonzalo, I apologize.
Okay.
And the reason for that is we've obviously got a lot of costs associated with originating this transaction. We're looking to make some money. So that return of 12.99% is effectively baked in the first 3, 4, 5, 6 years of this transaction. And then it starts to go down over time.
Look, let me also stretch a point to make a point. Back to the 10-year example here. In the grid, it shows the $1 million home is at 1.3 million, and we have a 45% ownership stake in that home. Let's say that home is worth $800,000 at the time of sale in 10 years. We participate at 45% at $800,000 without any clawback to the client. That's very important. So we do have some risk here in this transaction.
So if the value of the property goes down, your interest in the home doesn't go down, but the value of the property went down, so you've got some risk as well.
We share in that, and correct. And by the way, that client maintains and keeps the $200,000. And they have 10 years of operating $200,000 to do what they choose with that 200 grand. We don't have a hook on that.
Right. And the tax ramifications to the owners, gentlemen, you know, when you write the Chiefs check, in this case, on the screen is $200,000, it says Chiefs tax-free proceeds. Tell us why.
Yeah, so it's anytime that you effectively leverage home equity and not sell the house. You haven't sold the house yet. You're not selling the house
for another 20,
30 years.
Forward sale.
It's effectively a forward sale, Gonzalo. So that $200,000 represents a portion of your eventual sale of the property. So let's just go through an example here. You do sell the property in 10 years and you sell it for $1.343 million. Right. And we're entitled to 45% of that. The 55% that you're entitled to, which would be roughly $700,000 or so, plus the $200,000 that you got 10 years earlier, that represents your total sales proceeds as it relates to the sale of your house. And that's what you're taxed on.
Got it. Okay. That answers that question. So why don't you go ahead, Dan?
Yeah, so for the audience's sake, we're going through a lot of Q&A. All these Q&As will be baked into another document. So we have all this. So, and Gonzalo will be happy to distribute this at a later date when available.
Yep. Why don't you hit the third case study? I probably have another 6 or 7 questions, Dan and Craig, so go for it.
Yeah, so this one is a little bit different in that there's no health benefit. It's just a pure legacy play. It's just an individual who has fairly decent sized home, $1.5 million, a lot of money elsewhere, no mortgage, would just like to maximize the amount of money that, in this case, Larry leaves behind to his 2 high school kids. So he ends up wanting to buy a Securian Protector product, just under $1.1 million death benefit, single premium policy. And how does Larry do it? Well, we make an investment of $250,000 in Larry's home. Larry uses that $250,000 to buy upwards of almost $1.1 million of death benefit. We take an initial equity share of 16.67%. I just described how we got to that. That's the $250,000 divided by $1.5 million. And it caps at 37.5%. We can never own more than 37.5% of Larry's home. The IRR comparison, Chiefs versus cash, it's much larger, Chiefs versus cash, just because the leverage associated with this property, with this policy, is so significant.
So a perfect example where this is going to be overwhelmingly compelling is if this home were in a trust currently, paid off, there's a real opportunity here to supersize that trust in a non-gift tax environment. So those individuals that work with trusted estate attorneys or trust departments, by bringing the solution and making the solution available to that network of professionals, is extremely powerful.
Yep. So within the context of, there's a question I've been holding on to for just a little bit, so I want to get it out there. How do insurance and wealth management providers get comfortable with the perception that they are recommending a client sell an asset to fund a different asset simply to generate fees?
So this is, Gonzalo, it's no different than liquidating an investment portfolio
Or
or
cash?
or downsizing from one residence to another to create and or improve a lifestyle event that generates a fee. No different. And again, our proceeds are not required for insurance and or investment related constructs. There's a lot of times that individuals will use this for in-force financing, or their portfolio is appreciated so much that the tax ramifications for when liquidating a portfolio may have 2-to-1, 3-to-1 tax attributes, which is painful. But if we can access a tax-free cash through home equity conversion, that's powerful,
Yeah, well,
extremely powerful. And by the way, that does not create a commissionable event. That's portfolio protection.
by the way, they could also add a garage or add another bedroom or do whatever they want, right? I mean, at the end of the day, there's no requirement to buy a financial product. But
Yes,
there are,
or pay down an existing mortgage or pay off an existing mortgage. I mean,
yeah,
debt consolidation.
yeah.
So
I think I don't want to read too much into the question, but I think that the assumption is that somebody's doing a Chiefs to buy, somebody's pitching a Chiefs to sell them a product or to generate fees or commissions. I think that, what I would add to this is this may not be for everybody. If it puts the client in a better financial position and it puts their heirs in a better financial position, or if it allows them to age at home, which is a huge priority for people considering long-term care issues and long-term care planning, aging at home is a big desire. This just may be the way to make that happen. So I don't want to read too much into the question. I appreciate it. I think it's a good question. But it's got to be for all the right reasons, right?
no
So
question.
let's move on. Question about insurability. I mean, you probably want to check to see if your clients are insurable. If you are going to make recommendations for an insurance solution as part of a Chiefs transaction, for sure. Is your interest in the total value of the home or the change in value from the time the Chiefs was funded?
So at the end of the day, it's in the total value of the property. So if the property sells for, if we started the Chief transaction with $1 million property and the Chief settles when the house is worth $500,000, our interest is a percentage of the $500,000. Likewise, if the house sells for $2 million, our percentage interest is in the $2 million property.
Thank you. All right, couple quick questions, kind of fire questions here is,
Dude.
How do you value the home? You do an appraisal. So talk about that for a second. That's part of the process.
That's exactly right. And it's identical to the process that's used when you buy a house and you take out a mortgage. No different than if you sell your house and someone else is buying the house, and appraisal is done to determine the lender will make sure that an appraisal is done to ensure that the transaction is being done at fair market value.
And there's no financial underwriting.
Yep. Okay. And you do not take a discount or a risk adjustment on the home value day one, right?
No,
we do not.
Okay.
If the appraisal comes back at $1 million, that's the transaction price we move forward at.
Got it. How does Chief differentiate, I guess, from other home equity investments like Unison, Unlock, etc.? Great question.
Love that question. Pay attention.
Yeah, so that's a really important question. So our business model is, for all intents and purposes, a support and referral model to the advisory distribution network. By working with advisors like yourselves, we make the cost of financing to the consumer extremely efficient. And I'll just do a quick compare and contrast. Our product has a overall cost cap of 12.99%. The Unisons, the Points, some of these other HEI companies have a cost cap of 19.99%, 700 basis points higher. Why is that? A, because they go direct to the consumer. So there's a lot more costs associated with originating that transaction than it is with us. Two, they focus on the distressed part of the market, credit impaired consumers. It's the part of the market that we don't try to go near. We're actually focusing on the part of the market where homeowners have choices. They could pay for that policy with cash. They could pay for that policy by liquidating a portion of their investment portfolio, or they could pay for that policy by entering into a CHEIF. The Unisons of the world are competing against other reverse mortgage companies. They're typically competing with the customer who has no other option. And as a result, those costs tend to be very, very high. So yeah, we think our model is exceptionally efficient, and it shows in the cost to the consumer.
And one thing Craig did not mention, those organizations that you mentioned, Gonzalo, have expirations. Some of them have 10-year paper, which means the home must be sold or paid off within 10 years. The others are 30s. Ours is uncapped. We do not have an expiration. So no expiration. Our fee structure is 12.99 compared to 19.99. And what Craig didn't also mention are their points associated. Their upfront costs associated with the transactions are 4 to 5 times greater than ours.
Okay, so I want to ask two quick questions. I know you've got probably a few more slides, and we're at about 17 minutes before our time is up. So just a couple of quick questions. One question, do you have a program that looks like an annuity, like a fixed amount per year for 10 or 20 years? I'll go ahead and respond to that, because you can take a lump sum and buy an annuity if you so choose. So I don't know if you want to change that answer or modify it in any way.
So to answer your question, we've got, infinite examples of product. And it's not like Craig and I sat back here and identified, the needle in the haystack, which product, what age is going to compete the best. We created a quoting widget that Gonzalo will have access to, where literally you can plug and play any product, any structure into this model, and it spits out the IRR associated with the corresponding CHEIFS funding.
Yeah, in fact, Gonzalo, the example that you just described is perfect for in-force financing. If you've got a client who's got a significant whole life policy and they're writing a check of $50,000 each year, which by definition is coming out of their investment portfolio or depleting cash on hand, you could use a CHEIFS, buy a single premium immediate annuity, and have those annuity payments continue to finance that existing policy. It's a great way to keep a policy in force.
Yeah, and again, I would just caveat it by saying every client is different, every facts and circumstances are different. I mean, you guys are the financial advisors, the attendees on the call. You need to decide how to best use CHEIFS for your clients. Couple other quick questions. I think one question was, can you share the IRR calculator? I think you said that we have that. So I don't know if that's a shareable document, or we can talk about that, or I can call the attendee. If we successfully refer someone to you, is there any fee that we make?
That's a great question. The answer is no. There's no fee. Just like you're not in our pocket, we're not in yours. So again,
if we were to pay, split, you don't take commission splits if a product is sold. Okay.
But more importantly, as you know, Gonzalo, we are anxiously want to align ourselves with distribution and those individuals that are passionate and most importantly understand the structure, because there are going to be some individuals that come to our front door, consumers, that will need advice.
Yeah.
Because it's only a matter of time before all the presses pick up on this. Again, it's the most efficient home equity conversion instrument in the marketplace. It's only a matter of time before CNBC puts Craig and myself on national television, and the consumers are going to come to us looking for advisors that understand how to properly position CHEIFS.
Well,
hey,
it
Dan,
takes us
excuse me, this is Kathy. Dan or Craig, is there a desire to take this direct to consumer?
No.
No, in fact, it's the opposite of that, Kathy. We've already started to take in some cases, and as it turns out, they were just referrals from non-advisors. And now that the website has been stood up, chiefs.com is where you can go. We're starting to get some inquiries. And where we want to be is at a place where we've got relationships with advisors around the country, where if someone comes to us, we can refer that potential customer, over to one of our advisor clients.
And
Okay.
Kathy, yeah, so what we do up front is one of the questions we ask the consumer, the seller is, use of proceeds. And again, that's not a requirement in our process, but we would like to have that intelligence that says, how do they intend on using it? Is it for healthcare? Is it for income? Is it for legacy? Is it 529? Is it debt consolidation? And from that, is it an addition? And from that, we could do a soft handoff to a professional that's in our network.
That's right.
Okay, so the questions are slowing down. I'd like to spend, I know you've got some advisors and markets and probably another slide or two, but I want to talk about, before people start jumping off, is walk us through how a transaction gets started, like paperwork, is there a FICO minimum, kind of how do you do the appraisal? Like walk us through start to finish.
Okay, before Craig jumps in, this is our last slide. So let's focus on questions and get this stuff. So I'm sorry, Craig.
Yeah, so, and Gonzalo, I think your question has two parts to it. There's the part where we've educated, trained, and are supporting your advisor clients. And we've got, there's another individual with Dan and I right now, Tyler, who's sitting next to us, who's in our sales and support office. And his job is to make sure you understand how Chief works and how it can be incorporated into your financial retirement legacy planning conversation with your client. And we're prepared to speak with your client. How long that process takes is up to you, the advisor, and your client to get to a place where you decide Chief makes the most sense relative to other funding alternatives. Once you've decided to go forward, we actually take over and we will set up the call to take an application. That process takes literally hours. And we then start the processing of ordering an appraisal, ordering title, and other documentation, going back and forth with your client. And of course, we'll keep the advisor informed. It's another role that Tyler and his team does. And like any kind of mortgage or home equity line of credit fulfillment process, it takes 3 or 4 weeks, with the long pole in the tent being that appraisal. If that appraisal comes back in a couple of days, we can get this done in 2 weeks. The appraisal takes 2 weeks, then we're looking at more like a 4-week process. So we go through that, we underwrite it. Remember, Dan said before, our underwriting is mostly about validating the value of the property and making sure we truly have a interest in the home that is unencumbered.
That's so there's no FICO minimum, which was one of the questions.
680 is the FICO minimum.
Got it.
And
but Dan, that's suggested 680. Craig and I control it. Again, mass affluent and up, that's the zip code we're playing in. Typically they're going to have FICOs at 680 up, but if somebody comes in at a 580 and they're sitting on $1 million, $2 million home, we're doing the transaction.
We'll have that conversation.
Yeah.
And just some other things.
Who pays for the appraisal?
What's that?
Who pays the appraisal?
Who pays for the appraisal?
Your client will pay for the cost of the appraisal.
Okay.
Just some other things, Gonzalo, that are probably important to note. We mentioned before, it can be done on a house with no mortgage. It can be done on a house with a small mortgage.
Or a second home.
No issue at all. It can be done on a second home. It can be done on a third home.
You could use your first home to buy a beach home.
It can't be done on a rental property. It must be owner occupied, but it can be done on first home, second home, third home. It doesn't matter. We're indifferent. What we're not indifferent about is rental property. We can do it on a lot of different types of properties. Condos are good. Single family residential are fine. We're now, just to put it out there, we're able to do business in 7 states. The biggest states that we can do business in are California, Arizona, Florida, Pennsylvania, and Massachusetts. And we've got 20 other states teed up. So
well, you know what? Now that Craig mentioned 5 of them, I'll give you the 2 others. That's Ohio and Missouri.
So
the approval process is going to be, you've got 20 states. I've seen a few of them roll in. They were 4 about 10 days ago, and now there's 7 or 8. It seems like the process is beginning to move. Can you explain why that is?
Yes. The most important thing was when we locked down the $285 million of financing, we knew that this was all systems go. So we've begun to hire more people. We hired a licensing specialist just 2 weeks ago, and she's a firecracker. We were just on the phone with the state of New Jersey for an hour earlier today. That's one of the states that we expect to get approved shortly, finally. And we've got another 20 states where her bonus is tied to getting those states in the next couple of months.
Great. That's motivation.
Oh, yeah.
Totally.
So you want to talk a little bit about the market and the advisors and so on this slide. So I think that's important as we begin to wrap up. And I'd love to, there's one more question. I'll ask that in a second, but I want to make sure that we're respectful of time for everybody. But, where are the markets? What are you guys seeing? How can we continue to provide opportunities for advisors on the phone?
Well, great. So Gonzalo, fantastic. So this sheet Craig and I put together a handful of weeks ago, and this was basically bubbled up based on the journey that he and I have been on. Obviously, the left side of the advisors, that list is going to continue to grow, but these are the obvious pockets of advisory that obviously these individuals are in a position to really help consumers age in place, holistic planning, and or improve lifestyles. And on the right side, the markets, these are basically products and some examples. And again, the purpose of this is to spur ideas from your audience to say, wow, here's an opportunity to partner with an elder care attorney or an RIA, bring something new, bring something fresh to market that brings a lot of consumer value, that does not create tension with the wealth advisor. You're now partnering with the wealth advisor. It's portfolio protection. It's holistic planning. So again, it's an example to spur ideas and obviously create opportunity for Chiefs funding.
And Gonzalo, I think what's going to happen is, we went through a couple of scenarios today. You could call it legacy planning was one scenario, a couple of, how do I improve my ability to successfully age in place? Those were some of the other examples. And those are very, very powerful scenarios. And millions of people are going through those kinds of challenges today. But it goes, I think, just way, way beyond that. 529 plans, the ability
The leverage.
to take tax-free proceeds, invest those tax-free proceeds in tax-free earning assets, where ultimately you could leave a legacy for your grandkids, your great-grandkids, many, many years down the road. It kind of goes back to do I want to earn 3-4% on my house, or do I want to earn 11-12% on other,
Tax-free.
Tax-free on real performing assets?
Got it.
That came from a wealth advisor that said, you mean to tell me I can have grandma and grandpa fund 529 plans for the grandchildren? Yes.
Yeah. I mean, there's an unlimited use of
That's the point.
applications
Yep.
here. And it is, and again, I always focus on, I think your $31 trillion number was updated to 35 trillion not too long ago by a Wall Street Journal article that I read.
I think you're right.
So I'd like you to put up the last slide with your contact information as we begin to wrap up. We've got a few more questions. So for the folks in the audience, please jot down their phone numbers. They are, as I said, I've known these guys for almost 30 years and we've worked in a lot of capacities together. Great guys. We wouldn't be having this webinar if we didn't think that. One of the questions, Dan and Craig, is Cornerstone an independent company or part of a group?
Yeah, so interesting question.
I love it.
So Cornerstone Financing is a New Jersey-based company that Dan and I are the majority owners in. We've got a lot of other investors, including the nearly 20 employees in our company who are all investors in the company. And I'll just, a shout out to them. These are seasoned professionals who have literally done over the years tens of billions of dollars of home equity originations, fulfillments, and securitizations. It's a big part of our business, which we didn't talk about. And that is, we take these chief contracts and we securitize them and we sell them to institutional investors, like a lot of the insurance companies whose policies we help fund.
Yeah.
So we're open for business. We're going to be in a lot more states over the next couple of months. We have, practically speaking, an unlimited amount of financing behind us. And we think we have a business model through the Gonzalos and Agency Ones of the world that create a very, very compelling value proposition to your clients and to you. Nothing better than helping you grow your business and serve your customers better. And this is how you can get in touch with us, cornerstonefinancing.com or chiefs.com.
But to answer your question, Gonzalo, we do have two very large institutional partners that each own 10% of the organization.
Okay, great.
Okay? Yes. So we've got some extremely deep pockets behind us, and that's only going to continue as we start to originate.
And
continue
that's obviously it's a minority interest. Can you?
Yes, minority interest. Craig and I
Thank you.
control the organization. Yes.
Got it. One last quick question that was popped up here. Mandatory annual community association dues are the responsibility of the owner. Since Chiefs becomes an owner through the acquisition, is there a pro rata on the annual fees?
You know, it's a great question. So
We've heard that before.
that's right. So
You're going to love the answer.
yeah. So Cornerstone, while we may own 20% of your house, we're not going to live in the house 20% of the year. We're not going to live in the house at all. It's your house. So you're paying all the HOA, you're paying all the taxes. If you decide to take $100,000 and invest it in your home to make it nicer, you benefit from that.
I was planning on giving you 20% of my cable bill.
So we can watch 20% of the TV.
Come
Netflix.
in, yes.
Okay.
Love it.
Awesome.
All
Good
right.
idea, Kathy.
So we do not have any more live questions, at least for now. We're at 3:57. Kathy, do you have any final comments? And I can wrap this up.
I think we're good. Well done, gentlemen.
Oh, thank you.
Kathy,
Yeah.
thank you. Lisa, thank you. Gonzalo,
Really appreciate it.
thank you.
Well, I would just say to the folks on the call, we're super excited about this as an opportunity really to provide a lot more holistic opportunities. I mean, if you look at what Chief stands for is, it ends in financial success. I think that if we all apply, the skills that we have and incorporate Chiefs into our conversations, I think our clients will have the opportunity to have more financial success. So thank you all for being on the call. Dan, thank you. Craig, thank you as well. And thank you everybody that was associated with this today. So gentlemen, appreciate it. All the best. Merry Christmas to everybody. And it's been a lively one. This was a good one. So thanks so much.
Oh, great. Thank
Appreciate
you
it.
all.
Thanks,
Appreciate it.
everybody.
Everybody, take care.
Thank you.